So my name is Vijay Chilka. I'm Vice President with Altport Investments, and we are introducing this product, which is new, which is in AIF Category 2, with a theme of startup to scale up. So it's an interesting industry and as an underlearning asset where there is a good scope of growth. So in detail, we will talking about this product through the founder himself, Mr. Majumdar sir. So before that, I just wanted to introduce him officially. It's my privilege to introduce such a good person. Uh, so Mr. Mazumdar is a partner with investment banker, and he is a seasoned investor in technological industry. In the past, Bhaskar has established himself as a well-regarded early-stage investor advisor, especially in UK and in India. He has held senior positions with Times of India, Z Telefilms, and Alta Vista UK. In 2000, he has started his entrepreneurial venture with Recreate Solution, a company within digital media, which was backed by Insight Partners. After scaling up this business, he has sold this business to US systems integrator. He has since been an investor in numerous technological companies and media early stage businesses through his proprietary fund. Ventures has an invested in prop funds in 7 startups in UK and India across media technologies. He has exited as an entrepreneur, as an investor, and brings a strong sense of positioning businesses for exit, because exit in any business is a prime important thing. So the exit is also an important thing to be noted. Now talking about his qualification, he is an alumni of IIT Kharagpur, Harvard Business School, and a very active member of Angel Community Network in UK and in India. He brings an international flavors to the fund and would enable early stage businesses in international rollout strategy, as well as bring potential targets for international business looking out for strategic entry into India. So just wanted to know what is the potential, what are the companies that will be selecting, and how it will be beneficial for our investors to investing. What do you say?
So, thank you very much. So before I get on to answering these questions specifically and other questions you may have, Vijay, I just wanted to give you a flavor of the fund and more importantly, just give you a sense of what venture capital and AIF within the venture capital category is all about. So as you all obviously know, we are a Cat 2 AIF fund, and we are a venture capital fund, which basically means we invest in early stage growth companies. And as these companies grow and future rounds start happening, we then again back these companies at later rounds. And then finally, as very rightly mentioned, we start taking exits. So this is the core of what a venture capital does. In India, the venture capital industry is relatively a new industry. It's still about less than 20 years industry. And most of the VCs today who are homegrown like us, not the American VCs who came, almost all started in after 2010, 2011. We started in 2015. And when we started, we were I think the third or fourth AIF. Now, of course, there are more than 100 AIFs within the venture capital category, but still our performance is easily among the best. So I'll quickly recap and give you a background. My background has already been mentioned. I started the fund in 2015 along with my partner. His name is Anil Joshi. So while I have been a successful entrepreneur exiting businesses twice, and before that was a global corporate executive, Anil comes more from the investment world. So after his corporate stint with the Billas, he used to work for a very large family office in India from early 2000s when family offices were very new in India. But what he is known for is he started India's first angel platform, called Mumbai Angel. And through Mumbai Angel, he played a very, very active role in educating people like yourselves, ultra high net worth people like yourselves, family offices, about startups as an asset class. And this was from 2008 to 2013, much before people had even understood what startups is all about. He, of course, worked with SEBI in coming up with the angel fund concept, and some of the big names now, like Lenskart, which is doing an IPO, Mintra, and all these companies. In all of them, through Mumbai Angels, he was the first check writer. So he's very well known in this market, and we both came together to start the fund. Right now, we are just closing a third fund, which is a 1,000 crore fund, but we are now in the green shoe area, and we will close it at about 1,200 crores. Before that, we've had two earlier funds. The first fund was a very small fund. It was a 100 crore fund, which we raised in 2016. That fund was performance has been, as I mentioned, as per the CRISIL report on AIF, the best performing fund. In that fund, we have returned three times capital back to the investors, and we have still one underlying asset left, and which was a company called Open Bank, which was India's 100th unicorn, where after us, very large VCs, global VCs like Temasek, Tiger Global, some of the big names like Google, Visa, Mastercard, ICICI, all of them came in. And we still have to take an exit in that business, and we are looking to take an exit. So the first fund will be about a six times capital back to the investors in just over an 8-year period. Of course, we take money in four tranches, so that's why our IRRs are very high. The second fund was a 2020 fund, which was a middle of COVID fund. We raised the money that was slightly larger, about a 250 crore fund. In that fund also, the performance is very good, and we have started returning small capital back to the investors. Uh, and now we are raising the third fund. Typically, our funds are 7-year-old funds, and then we seek extension. The good thing in this fund is already almost 2 years have passed, and we are ending it by September, so uh, which is when we'll complete 2 years. And so people who like yourselves who are coming in now will still be able to come in at par. And very interestingly, although coming in at par, there has been substantial hike in the performance of some of the companies. So on an invested capital basis, we are at about 1.9, and three of our companies have had significant up rounds, and a couple of others are also there. So this is broadly our background. Praveen, who's on the call, heads our investor relations team. And apart from that, we have a team of about 18, 19 people based in Mumbai. So this is the core of the fund. Yeah, you're on mute. I can't hear you.
So it's very good to understand the AMC first. Can you just elaborate more on the fund? Uh, so that I can then ask the questions on that, and we can
Sure.
build on the product.
Sure. So two, three quick differences that we have vis-a-vis some of the other investors, the other VCs that are there, I'll quickly touch upon. So one big difference is, as all of you all know, in India, most of the startup investment money goes into Mumbai, Bangalore, and the NCR region. In our case, two-thirds of our investments are outside of these three regions. So we have multiple companies from our portfolio, almost two-thirds of them right across India. So we've got companies from Cochin, Trivandrum, Hyderabad, Chennai, of course, Pune, Bhubaneswar, Jaipur, Ahmedabad, Indore, right across India. So what this means is we get to do a lot of proprietary deals, and that's where Anil and now the rest of the team, the background, because we are so clued on to at the ground level in the ecosystem we do. And the advantage of this is because the deals are proprietary, because we know the founders for a couple of years before they are looking to come to the market to raise money. Because of that, our entry price into the deals is much better than an average Bangalore VC. So this is one very big difference we have. So we are not a, as I keep telling my friends from the industry, we are not a lazy VC sitting in Starbucks in Koramangala or in BKC and signing term sheets. We are there deep within India to source deals. The second big difference we have is the average age when the founder, when we sign a check for the founder is 41 years. So we tend to back a lot of, folks who've been 15, 20 years in the corporate world, now come out to do their own thing, uh, and who've put in their own, 10 odd crores in the business, 5, 10 crores in the business. These are the type of people we tend to back mostly. While we have some young founders, these are the type of people we tend to back. So this is the other big difference we have. I think from a sector perspective, it is very important what we are investing in this fund for you to know. But I'll quickly backtrack and give you our historical perspective. When we started the fund in 2015, all of us recollect those were the days, first time the whole digital India was coming into place. First time, the government came up with the public digital infrastructure. We remember those days when Geo launched and brought down the prices of data. So, and first time digital infrastructure was rolling out in India. So at that point in time, most of the companies we invested were companies which were using the whole UPI system and everything else. So a large number of fintech companies, health tech companies we invested. Some of them have, one of them is an unicorn, another of them is about to become a unicorn. So these were some of the companies we invested from the first fund. The second fund was more or less the same strategy, with us now also investing a lot in what global SaaS companies are. Zoho, whose platform we are in, is the epitome of the global SaaS companies out of India, and some of the companies we invested are also very similar, going into the international market and scaling up very fast over there. This fund is a very differentiated fund. This fund is a deep tech fund. And what is happening in the world today is the world is looking out towards India, not from any more as a cheap IT services or a BPO perspective. That is all given. But the world is looking to India for from an innovation perspective at lower cost innovation. And these are the type of companies we are investing in. And along the course of the conversation, you'll hear some of these companies that we are talking about. What does deep tech mean for us? These basically mean that there is a strong intellectual property in these companies. And today, as some of you all know, in India, the whole intellectual property framework has become very strong. It's no more that, patents are not respected or trademarks are not respected. These have become very strong. The second very interesting thing why the timing now is right for deep tech in India is because we all know, whatever short-term bumps there is in tariffs, that aside, that manufacturing has started to move to India. And I don't mean low-end manufacturing like, toys and garments, but higher-end precision engineering manufacturing, electronic manufacturing, semiconductors. These have started to move to India. And finally, after years, the Make in India now has started to see a big success with some of the schemes like the PLI scheme or the design linked incentive scheme starting to see the light of the day. The third very, very important point, and for me, this is the most interesting and important point, is for the first time in the history of India, I think we are starting to see that startups are starting to come out from the leading and top tier institutes of learning in India, whether it is the IISc Bangalore or the Indian Institute of Technologies or Indian Institute of Management or other top tier universities. And in these, the faculty is owning the intellectual property. They have access to all the research and R&D facilities of these institutes, and they are coming out to do their own startup. So I think for me, this is the seminal moment in the Indian startup history where you will see a new generation and new type of startups coming, very similar to what happens in US, Israel, and these parts. And these are the types of companies we are looking to invest. Within this, from the sectors we are investing is in space technology, is in semiconductor design. A lot we are doing in defense, because as we all know, defense is one of the biggest growth areas of India. Then we are doing in specialized healthcare type of industries and in climate. So we are moving, as I keep saying, more and more outside software into core engineering. And that for me is the real growth area that is starting to come in India.
So it is an AI based plus a deep tech technology platforms,
That's right. That's
which
right.
makes a revolutionary change in the business model.
Absolutely. Absolutely. So I don't know how many of you all saw the recently. If you're not, I should entreat you all to see the last week. Elon Musk had come on a webinar and he had spoken. And what he said is absolutely correct. Whenever you have AI as the software thinking, but the output is not software, but the output is manufacturing led things, that is when the power of it will come, like AI driven robotics. That is the true power. And we, in our small way, are starting to get into those areas. AI, for me, just to answer, is a horizontal. Everything in the world, whether it is software, whether it is factories, will use AI, because at the end of the day, it is intelligence, and more data is thrown in, more intelligence. So, core AI, we are there, but we are using that for applications.
So I just wanted to know, is there any red flags, the set of companies which you totally avoid to invest in this fund?
So the broad red flags that is there in the fund is there in any startup business. So I think since a lot of investors would possibly looking at the VCs for the first time, I think it's important for us to red flag about the asset class itself. This is an asset class which needs, which people evolve into. It is not an asset class where first time investors would like to get into. And my personal advice is also against that. In US, typically, family offices or even ultra high net worths have as high as 15-20%, maybe sometimes even more of their assets deployed into this asset class. In India, of course, it's early days, so the deployment into the asset class is much less. But we have seen over the last 10 years that I have been in the trade, we have seen this increase substantially. And people today are starting to allocate right across because they have started to understand this asset class. Fundamentally, to answer your question, rather than our portfolio companies, I think this asset class has two, three distinct risks. One is it takes time to develop. Because it takes time to develop, if in between a 7-8 year period, investors get jerky and nervous, of course we can provide liquidity interim, because we have certain investors who are always looking to provide liquidity if anyone wants to exit out. But that is not a recommended model for us, because you would be shortchanging yourself, because in this asset class the growth really starts to come after the 6th or 7th year. And typically, our advice is you have to have the staying power for you to be really able to gain. So, one, it's a long duration asset class. Two, it's a high risk, high reward asset class. The way we invest very judiciously. With although we are early stage investor, we only use 20% of our funds to create the corpus, and the rest 80% we back after the companies have crossed the risk threshold. So literally only 20% is the risk part that we take to go in early and take a substantial position. And because of that, when failures happen in our business, failures happen. Typically, our first fund, we had to write off 4 out of 17 companies, which is about 25% uh, fail rate, which is much better than the average industry standard. And although 25% was a fail rate, from a monetary perspective, it was only about 6 or 7% because of the way we invest. So to answer your question simply, people have to have staying power and a mindset that this money will take time to mature. And second, very importantly, they should not get nervous in between hearing the write-offs if it happens. In the present fund that we have constructed, we have already constructed 17, 18 companies out of typically a 20 company fund, 20 company portfolio that we do in every fund. I don't think there is any company which is anywhere close to a write-off. All the companies are doing very well, and in fact, This fund is a fund where we are starting to see maximum second round funding coming to companies. So, I think from that perspective, this is a very good portfolio we have created.
Okay. So one of our investors also wanted to know what is the potential of this underlying asset, which is in a startup, compared to the traditional manufacturing and the businesses. So, what is the growth potential in this industry?
See, startups are basically, game changing. And at the end of the day, if we take a philosophical view, every company, even if it is Reliance, was a startup one day or the other. So every company starts up one day or the other. Startups, the way the government defines it, is basically companies which have less than 10 years in existence, less than 50 crore top line, and all of that. From our perspective, the growth in startups, needless to say, is going to be very, very high. Most, and there will be certain companies which will fail. From an average fund size, if you see, and there is number of data, and I don't want to rubbish, or I don't want to look down upon any asset class, because every asset class has a role to play in a portfolio construct of an investor. From an absolute return perspectives, AIFs have done much better than the Nifty, and within AIFs also VCs have done well, and within VCs also we are among the best performing VCs. So if you can see, our IRR in the first fund has been about close to 50% or so. Net IRR would be late 40%. In the second fund also, our IRR still is about early 40s. So my take is the growth in the startups. And in startups, my advice to individuals is not to do direct into companies, because signing a check is the easiest thing to do. After that, what? So if you were to enjoy this asset class, enjoy the returns of the asset class, you have to come in with through funds like us. And because we have a portfolio strategy, because this is all we do 24 by 7, because we work with the companies, enabling them to do the next round funding, everything, our returns are commensurably much higher, because we proportionate things. So one is, it's a high growth sector, and very importantly, it is a habit changing sector. We don't invest in consumer internet, but if you see the Zeptos of the world, they have changed the basic consumer habit. Obviously, if you are habit changing, it takes much longer time to break even and understand. But fundamentally, startups have a huge growth potential in the growth of the country.
So, as we know, these are the new age companies and with the new business models. So, can you just share us some businesses that you have invested in this fund, which is unique in its idea and has a very good potential of growth, and which makes a very good social impact in the society as well?
So I'll give you two examples, one from this fund and one from an earlier fund, but it will give you an idea. In an earlier fund, we have a company called Gen Robotics, you know, and because you said societal impact, I just wanted to link societal impact also to profitability and scale up. So Gen Robotics was a company we backed. Four young founders. When we backed them, they were about in their mid 20s, just out of college. Even now, after 6 years, they must be late 20s, early 30s. Young founders, and they wanted to do two things. They were very passionate about robotics, and at the same time, they were passionate about exactly using the words you mentioned, societal change. And the first product they came in from a call from the Kerala government was to use robotics for cleaning manholes, sewers cleaning. And we all know in manual scavenging that whatever we talk about India's progress and Viksit Bharat and all of that, but still it's sad that even today in India, more than 1,000 people a year die from the gases when they go down to clean sewage. So these guys came up with a robotics arm through which the whole sewage cleaning can be done. Great cause. If you search for them, you'll see they are mentioned in the parliament and everywhere else. But this company has been profitable from the second or third year of their existence. Now they are close to 100 crore company. They found a number of other used cases for their robotics. Obviously, the sewage cleaning is one, but big user of them is the oil and petroleum industry, because they had to shut down the factories for cleaning the slug. Now the factories are running and the robotics arms are using for cleaning the slug. Similarly, in the Middle East, of course, there is no sewage cleaning, but the sewage is blocked because of sandstorms. So in Middle East, they have started to have huge used cases. And this is one company which is doing good for the society and at the same time highly profitable, easily a company which we see going on to the IPO path in the next couple of years or so. So this is one example. The other interesting example I'll tell you, from this fund, we have a company called Orbit Aid. Just think of the vision of the company, of the founder, and where the company is going. So this company is basically in the space, and as all of you all know, one of the big areas of growth within India is going to be in space. I see India becoming almost like IT services, becoming the home of almost all global launches taking place, not just through ISRO, but through a number of private players like, not our portfolio companies, but companies like Skyroot, Pixel, and others. But this company is not in the launch area. They are in a very, very specialized area. They are refueling in the sky. So the problem statement that they're trying to solve is, whenever a satellite launches, about 50% of the payload of that satellite is fuel. And fuel typically runs out in 6 7 years, but the electronics are alive. And that's why they become, debris in the sky. What this company is doing is they are doing launches, and every launch they do, think like an oil tanker that is going in the middle of the sea to fill up ships that are there. That is exactly what they're doing. They're sending oil tankers on a returnable basis from here. Each launch they will be able to refuel 6 or 7 satellites, and once the refueling is done, that launch vehicle will come down to sky. Now, the team we backed have been space scientists in ISRO, in NASA, and other places. Came back to India. The whole team is space scientists. They are in what is called technology readiness level 9, which means they're ready for a non-commercial launch, and the launch is happening on the 27th of November from Sriharikota. This company has used only about $3.5 million to reach this stage. There is a similar company, the only other company in US, a company called Orbit Fab, which has raised about 70 80 million dollars, and they are about 2 years behind them at TRL 6. So it is companies like this which will change, and I can see this company after the launch, easily becoming $100 million plus company. We invested in this company very early, even before they were at TRL 4 or 5. We took the risk, backed the management, and once this launch happens, this company is going to be the talk of the town. And it is companies like this that we are doing. So they are great for the nation. They are serving a purpose of sustainability in the sky. And these are the types of companies we are backing more and more.
That's very good, sir. And now talking about the business and the return part of it. So what is an ideal mindset show of an investor who is investing in this, and what should be the uh, based on the past returns and the past companies, what would be the expected return? But I think most of the investor would be interested to know on this.
Yeah, absolutely. So as I said, this should not be more than 10 15% of your portfolio. That is number one. I would even, till recently, we would not take in retail investors. We would only take in family offices and institutions. But now we have started to take in retail investors in this fund. So if it's a retail investor, we would say start with as small. I mean, obviously it's an AIF, so 1 CR is the minimum. But I would say that start small, get a feel of the asset class, because it's a addictive asset class. You'd like to be involved in this whole nation building. While you can get money returns from everywhere, but this is also a part of the nation building. At the same time, getting substantial returns back. From a return perspective, typically I'll just give you the cash flow type of thing that happens. So typically our aim is to be able to provide at least a 4 to 5x return in a matter of in a typically 8-9 year period, because you all are coming 2 years late. So in your case, the minimum period of the fund is 5 years, and it will go up to 7 years because of you all are coming in late. uh, at this point, when you're coming in, we would take 50% of the capital from you, and the remaining 50% would be paid equally over 2 years, 25% after 12 months, and the remaining 25% after 24 months. Typically, what we have seen is in a 7 year fund, in your case, it's 5 years, so I'll talk of the 7 year fund. We take money in 4 years. By the end of the fifth year, we give returns of about 10-15% of the fund. By the end of the sixth year, we strive to return the entire capital back to the investors. We have done that in the first fund very successfully. In the second fund, we are working hard. We've just entered the fifth year. So I think by the end of the sixth year, we'll return the capital. In the seventh and eighth year, and after 7 years, we take an extension. So in the seventh and eighth year, we want to give the maximum returns, typically another 2 to 3 times the capital back to the investors. And in the last year, we take special permission from our investors, where we see 3 or 4 companies are left. We want to hold on to them till the last stage because we want to maximize the return. In the first fund, we have not had any company which IPO'd during the lifetime of the fund, but after we exited out, 2 companies are IPOing. In the second fund, I think we'll have definitely one company which we can see going in for an IPO during the lifetime of the fund, maybe two. So we want to hold on to these companies till the last moment so that at least we can gain the real jump of it. So as I said, because these are not standard listed company where there is a 15% growth year on year, these are companies which are growing at exponential rates. And because they are growing at exponential rates, in some of these companies we want to hold on. So to answer your question, the investors can expect a IRR of about 35% or so.
That's good. And I just wanted to know more about, what is the exit strategy in this? Though, because as you said, uh, giving a check is very easy, but making an exit is the most important. So how are we making exit in this?
Sure. So for us, this is a closed-ended fund. So once and let's say it's a 7 year fund. So once we exit a business, the money goes back to the investors. We don't redeploy back, unlike some of the other asset classes. So I have been, as you know from my background, twice exited entrepreneur myself. My drive is to see that we are able to exit out businesses at the right time, not subscale also, not too late also, and trying to be greedy. I think typically our exits typically come under IPOs. When the company IPOs, we get an exit, which you all know. When a company undergoes an M&A, that time we get an exit, as you all know. And the third exit, what happens in our industry, is what is called secondary exits. Is when a company raises a large round. Let's say they're raising $100 million plus or $150 million plus. At that time, the newer investors want to clean up in a positive way the earlier investors at a particular discount. So typically 10-15% discount of the price they are doing. They want to lower their price. They want to be able to have control over the cap table along with the management. So they provide exit to the earlier investors. So this is typically the way exits happen. And most VCs, what they do is they wait for one of these things to happen. While in our case also, we've had this type of exits happening from this. In the first fund, we've had a company which sold out to Sun Pharma. We had a company which again sold out to Net Decisions. So exits we through M&A we've also had exits through secondary buyouts. But one area which we are active and where is a strong differentiator with us and our peer group has sort of noticed it is we want to provide liquidity to our investors proactively and not wait for the company to either do an IPO or an M&A or raise a large money to provide us exit. So I can give you two examples where we have proactively gone out and provided liquidity to our investors. So one is we proactively in the first fund had an investment which is a marquee investment in the first fund in a company called Open Bank, which happened to be India's 100th unicorn. In Open Bank, there was a point in time we held 8% stake in the business. So we sold 2% of our 8%, about 25% of our holding. At that time, the value of the company was about $500 million, and we sold it at $625 million at a premium to a Brazilian family office. Now, the Brazilian family office uh, knew the sector well because they had invested in a very similar company in Brazil, which listed on New York Stock Exchange. That company original found some of the original families which had invested. We reached out to them. They understood that sector. They understood Brazil, India, and within 1 month of our talking, they consummated the deal. And typically, that enabled us in the sixth year to return 1x of the entire fund. So nobody in the cap table were exited out. No, the company did not get any money, as happens in the other cases. But here we were proactive to go out and execute a structured deal. Similarly, we did another structured transaction where there was a large US family office which wanted to come into India, but they wanted to come into India in scale ups, not in startups, in companies which had done well already, companies which had raised north of $10 million, companies which were profitable. So from our portfolio, we curated 6 companies and sold it off sold our stake to this family office, and our investors got return. The company again did not get money, nor did anybody else exit. So we are always look out on structured deals, and I think that is a big differentiator we have with other VCs that are there. So exits, as you very rightly said, is the key for our existence, and we have to provide liquidity to our investors.
Hope we have got all the answers for this one, and we are very thankful for you to take your time and answer these questions and explain this product in detail. And from my entire team, I would like to congratulate for. So, any last note for the investor that you want to add on before we just
I,
end?
yeah, I think the last notes is this is a growing asset class. I can take a step back to say when mutual funds was coming into India 15, 20 years ago, nobody were understanding it. A lot of people were saying, why should we do it through professionals? We know which stocks to pick up, but it's a different genre and asset class with a different set of people with a different mindset. Similarly, in the private space also, some people will say, especially 10 years ago when we were raising a fund, a lot of people used to say this question, what is a big deal? Why do I need fund managers? Mere paas bhi 10-15 startup mahine ka aata hai. That is the easiest thing to do. Give up 25 lakh, 50 lakh, then what? How do you nurture them? How do you grow them? Are you on the board? Are you taking the risks? Do you have a strategy of portfolio? I think now people have understood that. The other very important thing to keep in mind, again, as I said, every asset is important, but any country, when it evolves, opaqueness goes out and more people know more and more things. So when opaqueness goes out, what happens is the capital markets, the growth becomes much less. You can see that happening in India. The golden days of, within 3 years rising 10 to 100% will never come back, because the economy is grown. It's no more a half a trillion economy, it's a 4 trillion, 5 trillion economy. You see US, even in the great years, at you know the growth in the markets is only 10-15%. In Europe it's almost flat. So the capital markets growth will reduce, and as the capital markets growth reduces, more and more people will come into the earlier part of it. And this we have started to see happen. You will see even the pre-IPO market, where I'm sure a lot of your investors are active. Earlier, between a pre-IPO and an IPO, there used to be a 40-50% pop. Now it's hardly 10-15%. So even the pre-IPO market is now not that lucrative. So we have a number of investors from the capital markets who have come into the fund or are creating early stage funds themselves, because as the nation develops more and more and grows, the growth will start coming in from earlier, because the early then becomes the driver for the future. So this is at a macro level. Irrespective of whether it is unicorn or not, all of you have to start thinking about how to get into the private space. And along with that, what comes is a different mindset of liquidity, of thinking, because these by nature are not liquid assets. Of course there are mechanisms, as I explained. If people really need liquidity, we can provide those, but by nature these are not liquid assets. So you have to have that illiquid mindset for a longer term gain over there. So for me, that's the only thing I'd like to say.
So I think we have got a good insight about the product, and hopefully our investors are totally aware and understood this product, and their queries have been solved over. And it's wonderful for you that you took your time to explain this product. And from my team, I would like to uh, just gives you thanks for this session.
Thank you very much. It's been a privilege to be on the call, and sorry again for the initial snaffles in joining.
Thank you.